Hey, what's up, my friend? So, in today's episode, I want to talk about how you, the retail trader, can beat the pros at their own game. So, here are a few things that you must do, right, to put the odds in your favor. Number one, you must remove the need to make money syndrome. So, what this means is that, often traders, they get involved in trading, they want to replace their full-time income, right? They want to get out of poverty, improve the quality of their life. But here's the thing, in trading, you will have losses and you will have winners, and hopefully in the grand scheme of things your winners are greater than your losses. So if you dive head into trading, right, and you want to quickly replace your full-time job to get a consistent income, then what's going to happen is that you will now be faced with the need to make money, because now there's no more safety net. You don't have a job. You have to force yourself to make money every single week or every month. If not, you can't pay the bills. And when you have this need to make money syndrome, what happens is that you tend to break your rules. You widen your stop loss, you average into your losers, and you do all the stuff, right, that is detrimental to your trading results. And that's because you have the need to make money syndrome. Oh, I must make money from trading this month. If not, I can't put food on the table. And once you have that mindset, it's a huge, right, disadvantage to you. And if you think about this, right, how the pros overcome this problem is like, for example, hedge funds. How do they do it? Even though we're all trading the same markets, but how do they overcome this need to make money syndrome? It is because of the payout structure a hedge fund is using. In the past, right, I would say not anymore now, but in the past, what's very common is that they tend to use the 2-20 structure. So every year, without fail, they'll take 2% of the management fee. And whatever profits that they make, right, they take another 20% out of it. So what's critical here is the 2% management fee, because whether they make money or not in a year, they'll take 2% of the asset under management. So if they manage $100 million, they are guaranteed a payout of $2 million. So their goal here is to really expand the pot that they are managing, right, and they make a lot, right? Or rather, they make more from the management fee. So they have something fixed, right, that can help them pay the bills no matter what. So that's the key thing, right? They have something fixed coming in, even though they are trading in an uncertain environment. So how can you, the retail trader, do something like this? Well, it's great if you have a side income from a business, from a job or whatsoever, right? To help you remove, right, that uncertainty, right, from trading the market. So that's the first thing, right? Remove the need to make money syndrome. Number two, as a retail trader, you have the flexibility, right, to do anything you want. You can buy, you can sell, you can trade whatsoever markets that you want. And this is something that the pros, right, a lot of hedge funds, mutual funds, they don't have this luxury. For example, a long-only mutual funds, they can only buy, go long, right? They can't go short because they are only a long mutual funds. And there are funds out there which can only trade stocks because that is their mandate, that is their philosophy. They can only trade stocks. So you can see that you, as a retail trader, you can pretty much trade anything that you please, right? Forex, futures, CFDs, whatsoever. So use that flexibility to your advantage, right? And also make use of the fact that you can do anything you want. You can even stay onto cash, right, when you feel that the market environment is not favorable to you. Whereas there are institutions out there, they don't have the luxury to hold on to cash, for example, because they have certain mandate to follow that. You can't hold on to cash because, cash doesn't earn you a return, and they buy something that is crappy and it earns a crappy return or even a negative return. So you can see that you, as a retail trader, you have this flexibility to trade whatever you want, when you want, how you want. Okay, so make use of that flexibility, right? Don't, think that you always have to be trading in the markets, because you have a choice, right, to stay out of the markets when things are not favorable, right? Having cash itself, right, is a position in itself. The third thing, as a retail trader, you want to stay away, or rather focus on the higher time frame. Stay away from the lower time frame, where the 1 minute time frame, the 30-second charts. And that's because that is dominated by high frequency traders. They are faster than you. They are more capitalized than you. They have better access to information than you. And clearly, right, that is a domain that isn't in your favor. So if you go up to the higher time frame, that's where you can level the playing field for yourself, because on that time frame, it's where high frequency traders, they don't want to get involved in, because it takes too long, right, to see returns. If you trade off the daily time frame, you only have so much trading opportunities over a year, whereas you trade on the lower time frame, right, seconds chart, a minute chart, you have much more trading opportunities. So again, right, stay on a time frame, right, where you are not as disadvantaged, right, which I would say is the higher time frame. Anywhere above the 4-hour time frame, right, that is something that you pretty much, right, won't be competing, right, with all this HFT traders. And number 4, as a retail trader these days and age, right, technology has improved so much. You can actually get tools, right, to help you validate your trading strategy, to help you extract an edge from the markets. You know, tools like Army Broker help you do back testing. Then you have data feed like, Norgate data, CSI data, where you can use, right, to validate your trading strategy, to know whether you have an edge or not. If you think about this, right, 10, 20 years ago, a retail trader won't have these tools. It's only reserved for the institutions, the funds out there. But now, for a few $100, right, you can have access to these powerful tools, right, to know whether you have an edge in the market. So make use of these tools, make use of technology to improve your trading, make use of technology, right, to find out, right, what are the behavior of certain markets and how you can exploit it. The tools are now out there. They are not expensive. They are within your reach. So make use of it, please. And finally, right, the last thing is this, right, is that doesn't matter whether you're a retail trader, you're a pro trader, prop trader, whatsoever, you have to respect risk. The market doesn't care who you are, what's your background, or how much money you're trading, because if you don't respect risk, it's going to be a matter of time, right, before you blow up everything, right? It doesn't matter if you trade for the bank. For example, Nick Leeson, right, he collapsed the entire bank, right, because of poor risk management. Then we have long-term capital management, right, a lot of prolific, right, traders, fund managers that go belly up because they don't respect risk. So what more of you, the retail trader? All the more you have to respect risk. This is money, your hard-earned money, right, that you are managing. So please, right, respect risk. Okay, so with that said, I have come to the end of today's episode. I wish you good luck and good trading, and I will talk to you soon.